Disclaimer.
Think you missed the silver rally because it already hit $78. Bank of America just told its institutional clients something that should wake up every American paying attention to their financial future. According to their commodity strategist, Michael Widmer, what we witnessed in 2025 wasn't the main event. It was just the warm-up act. While retail investors are celebrating what looks like an incredible 148% gain, professional money managers are quietly positioning for what comes next, and the numbers behind their moves reveal a crisis hiding in plain sight. Here's what should grab our attention. That $78 silver price everyone's talking about in January 2026. Bank of America's models show it as the starting line, not the finish line. The gold to silver ratio sitting at 57-1 right now is what Widmer calls coiled too tight, a technical term that basically means we're sitting on a financial spring that is about to release decades of pent-up pressure. Every time in modern history this ratio exceeded 80 and started falling, silver didn't just rise, it exploded in moves that made early investors generational wealth while latecomers watched from the sidelines. But there's something happening right now that's never happened before in the silver market, and it reveals just how urgent this situation has become. Between December 27th and December 30th, 2025, something extraordinary occurred that mainstream financial media completely missed. Chinese manufacturers and Indian industrial buyers did something they never do. They bypassed the global commodity exchanges entirely and contacted a Canadian mining company called Kuya Silver directly, not to negotiate better terms, not to establish a long-term relationship. They were offering $8 to $10 per ounce above the spot price just to secure physical metal. Let me put that in perspective. When large-scale industrial users who move millions of ounces are offering premiums that high, it means one thing. They can't find silver at any price through normal channels. These aren't small jewelry makers or coin collectors scrambling for a few ounces. These are massive manufacturing operations that use hundreds of thousands of ounces monthly, and they are panicking because the metal they need to keep production lines running simply is not available through the traditional markets where they have sourced it for decades. You might be wondering how this is possible when the spot price looks so orderly, trading smoothly on exchanges every day. Here's the uncomfortable truth our financial system doesn't want you to see clearly. While you're watching silver trade at $78 on your screen, there are actually two completely different silver markets operating simultaneously. The paper market, where futures contracts trade back and forth, and the physical market, where real metal changes hands. Right now, according to industry data, the paper-to-physical ratio has reached an almost unbelievable 356-1. For every actual ounce of silver that exists, there are 356 paper claims on that same ounce. This disconnect is already creating visible cracks in the system. The United States Mint and Canadian Mint both ran completely out of stock of silver products in late 2025. Think about that for a moment. Our own government mints that produce silver coins can't keep up with demand even as prices doubled. Meanwhile, COMEX inventories, the warehouses where silver backing those paper contracts is supposedly stored, have crashed 70% since 2020. The silver that's meant to be there to fulfill all those contracts is vanishing, while trading volumes keep increasing. In Shanghai, where Chinese buyers who actually need physical metal do business, premiums over the London spot price hit $80 per ounce in December. That's not a small arbitrage opportunity. That's a massive structural dislocation showing that in the world, this largest manufacturing economy, buyers are desperate enough to pay more than double what the official price suggests just to get real metal in their hands. Have you checked how much of your investment portfolio is in precious metals? If you're like most Americans working with professional financial advisors, the answer is probably less than 1%. According to industry surveys, professional money managers currently hold only 0.5% of their portfolios in gold and silver combined. But here's where it gets interesting. Those same managers, when they run portfolio optimization models looking at risk-adjusted returns and diversification benefits, consistently see recommendations of 20 to 30% allocation to precious metals. They know they should be positioned there. Their own models are screaming at them to move capital, yet they're sitting at half of 1%. That gap represents trillions of dollars in institutional capital waiting on the sidelines. It's not that professional investors don't understand the opportunity. It's that moving large amounts of money takes time, requires committee approvals, and often happens in waves during quarterly rebalancing periods. When that rotation begins, we're not talking about your neighbor buying a few ounces for their safe. We're talking about pension funds, hedge funds, and family offices moving billions of dollars into a market that, according to the Silver Institute, produces only 1.01 billion ounces annually against demand of 1.24 billion ounces. Every 1% of institutional money that rotates into silver essentially doubles the supply deficit. The timing of what's happening next makes this even more urgent. On January 4th and 5th, 2026, as political tensions with Venezuela escalated dramatically with U.S. involvement in the situation surrounding President Maduro, safe haven flows into precious metals accelerated. Historically, geopolitical instability sends institutional money flooding into gold and silver as the ultimate stores of value when paper currencies and government bonds start feeling risky. That pattern is already playing out, but there is a technical factor about to create what looks like a perfect entry opportunity for those paying attention. Starting January 9th, 2026, the Bloomberg Commodities Index must sell approximately $5 billion worth of silver futures because of automatic rebalancing rules. When silver gained so much in 2025, it became an oversized position in the index, growing from 4% to 9% of the total weighting. Index rules require rebalancing to maintain diversification, which means forced selling regardless of fundamentals or future outlook. This mechanical selling pressure will likely push prices down temporarily from current levels, creating what market professionals call a fake dip, a brief discount caused by technical factors rather than actual supply-demand changes. But here's the crucial part most investors will miss. That dip won't last because the physical shortage isn't going away. February and March are when solar panel manufacturers globally place their second quarter orders. These companies need millions of ounces to maintain production of the panels that are transforming our energy infrastructure. They're going to enter a market where other industrial users are already offering 13% premiums just to secure metal, where exchange inventories are at multi-decade lows, and where mining companies are fielding desperate phone calls from buyers who used to rely on commodity exchanges. The $78 silver price Bank of America discusses is not some theoretical peak to be afraid of. It is what their analysts consider the baseline before the real move begins. When you understand that professional portfolio managers are positioned at 0.5% instead of their model's recommended 20 to 30%, that Chinese manufacturers are offering massive premiums because they can't find physical metal through normal channels, and that COMEX inventories supporting 356 paper claims for every real ounce have dropped 70%. You start to see why Widmer describes the current ratio as coiled too tight. History has shown us what happens when precious metals markets reach this kind of structural tension. The spring doesn't just release, it explodes. And based on everything happening in the physical market right now, invisible to most investors watching orderly price charts on their screens, that explosion is already beginning. The question isn't whether silver will move dramatically higher from here. The question is whether you'll recognize this moment for what it is before the window closes, or whether you'll be one of the investors who watched it climb from $35, then hesitated at $50, waited through $65, and is now wondering at $78 if it's too high to enter, just as Bank of America is telling institutional clients that the real move hasn't even started yet. So where does Bank of America get these specific price targets of $135 and potentially $309? These aren't wild guesses. They're based on mathematical relationships that have proven reliable through multiple precious metal cycles over the past 50 years. When Michael Widmer talks about the gold to silver ratio being coiled too tight, he's referencing historical patterns we can measure and verify, and right now those patterns are repeating with remarkable precision. Let's start with 2011, the last major precious metals bull market. Gold peaked around $1,900 per ounce, and silver hit approximately $48. But here's what most people forget. At the height of safe haven buying and industrial demand panic, the ratio compressed all the way down to 32 to 1. When you take today's gold price averaging around $400 and divide by that historically normal, wild bull market ratio of 32 to 1, you get $137.50 silver. Not speculation, just math applied to patterns that have repeated consistently. The ratio hit 100 to 1 in early 2025. The most extreme imbalance in modern market history. Now it's fallen to 57 to 1 and still dropping because silver's industrial importance and limited supply make 100 to 1 mathematically unsustainable. But 2011 isn't the only precedent. Go back to 1980 during the currency crisis that had Americans questioning dollar stability itself. Inflation was running over 13% annually, the Federal Reserve had lost credibility, and geopolitical tensions with Iran dominated headlines. Gold soared to $850, but silver actually outperformed because the gold to silver ratio compressed all the way down to 14 to 1 during peak panic months. The answer lies in silver's unique position as both a precious metal and an industrial commodity. Gold is primarily a monetary asset. When people buy gold, they're protecting wealth. When industries buy silver, they're trying to keep factories running. That industrial demand creates what economists call an inelastic floor, purchasing that must happen regardless of price because modern technology literally cannot function without it. Solar panel production consumed a record 230 million ounces of silver in 2024, according to the Silver Institute. That's 29% of all industrial silver demand, up from just 11% a decade ago. New TOPCon solar cells require 50% more silver per panel than previous generations, and the International Energy Agency projects solar installations will exceed 500 gigawatts annually by 2030. Electric vehicles use 25 to 50 grams of silver each, compared to 15 to 20 grams in traditional cars. With global EV production projected to double by 2030, automotive silver demand alone could triple. These are not flexible buyers who can substitute other materials. Silver's electrical conductivity makes it irreplaceable in critical applications. Here's the stunning reality that should make every investor pause. Despite record prices throughout 2025, global mine production actually declined 2% according to preliminary industry data. Silver hit its highest prices in over a decade. Miners had every financial incentive to produce more, and total production still fell. This marks the fifth consecutive year of structural deficit, where the world consumed more silver than mines produced. The 2025 deficit reached approximately 149 million ounces. Analysts project the 2026 deficit could widen to 230 million ounces as industrial demand accelerates. Why can't mining companies just produce more? Because 75% of silver comes as a byproduct of mining copper, lead, and zinc. You don't just decide to open a silver mine when prices spike. The few primary silver mines that exist take 10 to 15 years to develop from discovery to production. There are no major new silver mines coming online that could materially impact global supply before 2035 at the earliest. China's move on January 1st, 2026, fundamentally changed global silver markets in ways most investors haven't yet grasped. The new export licensing system requires companies to be among just 44 approved firms, maintain minimum 80-ton processing capacity, and provide $30 million credit lines. This is not a minor regulatory adjustment. It's the effective weaponization of 60 to 70% of the world's refined silver supply. When one country controls that much of a critical industrial material and implements strict export controls, they've turned that commodity into a geopolitical tool. The timing of China's restrictions colliding with the Bloomberg Commodities Index rebalancing creates a fascinating opportunity for those paying attention. Between January 9th and January 13th, 2026, index funds must sell approximately $5 billion worth of silver futures to reduce their weighting from 9% back to the mandated 4%. This is forced mechanical selling that has nothing to do with supply, demand, or future outlook, purely technical positioning required by index rules. Now, what happens when that selling pressure hits while physical buyers are scrambling to secure metal? You get a temporary disconnect where paper prices might dip towards $70 or $75, while physical premiums explode even higher. Societe Generale issued a research note warning of a potential physical delivery crisis, where paper contract holders who expect to receive actual metal simply can't because there is not enough available. When that happens, contracts settle in cash rather than metal, and physical silver prices disconnect entirely from paper prices. The Shanghai Gold Exchange tells a story that London and New York price charts obscure. In December 2025, the premium for physical silver in Shanghai over the London spot price reached 80 per ounce on certain trading days. Normal Shanghai premiums typically run $2 to $5 per ounce to cover shipping costs. When premiums spike to $80, it means buyers are so desperate they're willing to pay almost double the official global price just to guarantee they get actual silver rather than a paper contract. Meanwhile, those Chinese manufacturers contacting Kuya Silver directly offering $8 to $10 premiums were not alone, according to industry sources. Multiple large industrial users have been negotiating directly with mining companies, requesting priority delivery arrangements and trying to lock in multi-year supply contracts well above current spot prices. We're watching two completely different silver markets operating simultaneously. There's the paper market, where futures contracts trade based on technical chart patterns and momentum algorithms. Then there's the physical market, where solar companies need millions of ounces for Q2 production, and mints literally run out of inventory despite charging premium prices. The paper market price of $78, and the physical market reality of buyers offering significant premiums above that price represent a gap that cannot persist indefinitely. History consistently shows that when paper markets and physical markets disagree, physical reality eventually wins. Now, let's work through the actual mathematics that support Bank of America's price projections, because understanding these calculations is what separates investors who recognize historic opportunities from those who watch them pass by. The $135 scenario isn't some aspirational target pulled from optimistic forecasting. It's what happens when the gold to silver ratio simply returns to normal levels seen in every precious metals bull market over the past 5 decades. Here's the calculation. Bank of America forecasts gold averaging $4,138 per ounce by year-end 2026, with current trading already around $400 and $400. Take that $4,400 gold price and divide it by 32, the ratio that appeared consistently at the peak of the 2011 bull market, the 2020 rally, and multiple cycles before that. You get $137.50 per ounce for silver. This requires zero speculation about unprecedented demand or miraculous supply disruptions. It just requires the market returning to historical norms that appear with reliable consistency whenever professional money managers decide precious metals deserve meaningful portfolio allocation. Think about what needs to happen for that ratio to compress from today is 57 to 1 down to 32 to 1. Professional money managers currently hold 0.5% of their portfolios in precious metals. Their own optimization models recommend 20 to 30%. You might be wondering what catalyzes that institutional rotation. Portfolio rebalancing happens on quarterly cycles, typically concentrated in the second and third quarters of each year, when asset allocation models flag that precious metals have become severely underweight relative to recommended positioning. Compliance officers and risk managers force portfolio adjustments regardless of individual manager opinions. It's not about convincing thousands of fund managers simultaneously. It's about triggering the algorithmic rebalancing that happens automatically when positioning gets this far out of alignment with optimization models. Based on current precious metals weightings being 95% below recommended levels, that rebalancing pressure is building toward inevitable release. But the $135 scenario assumes relatively orderly market conditions and moderate safe haven flows. What happens if dollar concerns accelerate beyond current levels? What if Federal Reserve balance sheet expansion, which resumed in December 2025 at $40 billion monthly in Treasury purchases, continues escalating as deficit spending grows? What if geopolitical tensions that sent investors fleeing to safety in early January intensify throughout 2026? That's where Bank of America's extreme scenario of $309 silver comes into focus, and it's based on the same historical precedent that gave us $135, just taken to the crisis levels we witnessed in 1980. The Federal Reserve's balance sheet expanded from $4 trillion pre-pandemic to over $9 trillion at its peak, contracted briefly, and is now expanding again. The dollar index fell 9.5% in 2025, its worst performance since 2017. These are not theoretical concerns about potential future problems. These are current conditions accelerating in real time. If gold reaches $5,000 per ounce, which sits within Bank of America's range of potential outcomes for late 2026, and the gold to silver ratio compresses to the 14 to 1 level seen during the 1980 currency crisis, we're looking at $357 per ounce silver. That's not a prediction. It's a mathematical outcome based on ratio compression that already occurred once under conditions that look remarkably similar to what we're experiencing today. Pop quiz? What do you think happened to people who said silver was too high at 15 in 1979 or clearly overpriced at $25 in early 1980? They watched it climb to $49 while they waited for cheaper entry points that never materialized until after the peak had passed. The 1980 ratio compression to 14 to 1 lasted approximately 6 months, was triggered by currency debasement combined with geopolitical chaos and supply shortages, and today's structural deficit is actually worse than 1980 in several critical ways. Back then, solar demand didn't exist. China wasn't controlling refined supply. The paper-to-physical ratio was not sitting at 356 to 1. COMEX inventories were knit down 70% from recent peaks while trading volumes increased. Here's your specific 2026 timeline that determines whether you recognize this opportunity or watch it develop without you. Bloomberg Commodity Index selling concludes January 13th. That mechanical selling pressure that has nothing to do with fundamentals creates your window between $70 and $75 if you're paying attention and willing to act while others panic about short-term price movements. The Venezuela situation remains unresolved heading into Q1 2026, sustaining safe haven buying flows into precious metals that historically spiked during geopolitical instability. Then comes February and March. Remember those solar panel manufacturers who need millions of ounces for production? They place Q2 orders during February and March. They're entering a market where industrial users are already offering $8 10 premiums over spot price, where COMEX inventories are at 30% of 2020 levels, where Shanghai premiums hit $80 per ounce, where our own government mints ran out of stock despite charging premium prices. What do you think happens to physical premiums when companies placing orders for hundreds of thousands of ounces discover that buyers before them have already absorbed available supply? Those premiums don't stay at $8 to $10. They spike to $20, then $30, potentially higher as industrial panic buying begins in earnest. Professional portfolio rebalancing historically concentrates in Q2 and Q3. That's when Wall Street's algorithmic models force rotation into assets that have become severely underweight. When $500 billion in institutional capital starts moving toward a market already in deficit, already experiencing physical shortages, already showing massive premiums in the world's largest manufacturing economy, the paper price can't hold. The 356 paper claims for every physical ounce become impossible to maintain. Cash settlements force prices to reflect physical reality rather than futures market positioning. The current 78 silver price won't exist by summer 2026. Think about the progression we've witnessed. Those who hesitated at $35 in early 2025 watched it climb to $50 by mid-year. Those who thought $50 was too high saw it push through $65 in the fall. Those waiting for a pullback at $65 are now looking at $78 and wondering if they have missed it again. But Bank of America is telling institutional clients that $78 is the starting line, not the finish line, because the physical shortage crisis hasn't even begun affecting prices yet. When it does, when solar manufacturers can't source metal, when portfolio rebalancing forces institutional buying, when the paper to physical disconnect creates a delivery crisis, the ratio compression toward 40 to 45 by year end puts silver at 100 to 110, even without extreme scenario assumptions. Have you noticed the pattern in our financial system? The invisible mechanisms that create wealth for those who understand them while leaving everyone else wondering why opportunities only become obvious in hindsight? This is one of those moments. Chinese manufacturers bypassing commodity exchanges to contact mines directly, offering massive premiums for physical metal, reveals a crisis that hasn't hit price charts yet. Professional money managers holding 0.5% in precious metals when their models scream for 20 to 30%, shows you where capital flows are headed. COMEX inventories down 70%, while paper to physical ratios reach 356 to 1, tells you the delivery crisis is already beginning, just not visible to retail investors watching orderly futures prices. The gold to silver ratio compressing from 100 to 1 down to 57 to 1 is not the end of the move. It's the beginning, because every previous compression continued down to 30 to 40 to 1 before stabilizing. The process takes 4 to 8 months once it starts based on historical precedent. We're approximately 3 months into that compression cycle, with the mechanical drivers accelerating rather than slowing, mine production declining despite record prices, industrial demand growing 15% annually, China weaponizing 60% of refined supply, solar technology requiring 50% more silver per panel. These aren't temporary factors that resolve quickly. These are structural changes that persist for years. So here's what Bank of America is really saying when they put 135 to 309 price targets on silver. They're saying the mathematical relationships that govern precious metals markets during monetary stress are reasserting themselves. They're saying the physical shortage that industrial buyers are already experiencing will inevitably affect prices once paper markets can no longer maintain the fiction of unlimited supply. They're saying the institutional capital rotation from 0.5% to even 5% precious metals allocation will overwhelm a market already in massive deficit. And they're saying it to their institutional clients who move billions, not to retail investors who think $78 looks expensive compared to last year's $35. With that opening crisis we discussed, Chinese manufacturers offering $8 to $10 premiums, mints running out of stock, COMEX inventories crashing, wasn't random volatility. It was the physical market screaming that something fundamental has changed while paper markets pretended everything remains orderly. The question isn't whether silver moves dramatically higher from current levels. Based on every historical precedent, every mathematical calculation, every physical market indicator, that move is already underway. The question is whether you'll recognize this moment for what it is, or whether you'll be explaining to yourself in late 2026 why you hesitated at $78, just like you hesitated at $35. $50 and $65 before that, while Bank of America's institutional clients who understood the invisible mechanisms were positioning themselves for ratio compression that's happened reliably every single time these conditions align throughout modern financial history. If you made it this far, you're exactly the kind of person who understands that real wealth is not built by following the crowd. It's built by recognizing patterns before they become obvious to everyone else. Hit that subscribe button and drop a like if you want more intelligence on the financial shifts happening right under the surface, because in markets like these, knowing what the institutions know before retail figures it out isn't just an advantage, it's everything.